All right, stop scrolling for a second because something big is happening right now in silver. And if you trade markets or even just watch them, you need to understand this. In the last week alone, silver has collapsed from about $121.64 down to the 81 to $82 zone. That's roughly a 33% wipeout in days. But here's the part most people are missing. Tonight, the CME margin hikes on precious metals officially go live with silver margins jumping about 36%. That's not background noise. That's a deadline. Both the exchange and clearing members have confirmed the hike, and I'm going to show you why today's close matters more than the headlines. Stick with me because once you see this pattern, you'll recognize it the next time it shows up. Before I explain what caused this drop, let me teach you something most people don't really understand about markets. Prices don't just move because of buyers and sellers with opinions. They move because of plumbing, credit, collateral, rules. Think of the market like a highway where leverage is speed. When everything's calm, people drive fast. But when the exchange suddenly narrows the lanes, you don't slow down gently, you slam the brakes. Margin requirements are exactly that. They don't ask whether you're right or wrong, they just ask if you have cash, and if you don't, you're out. That's the lens you need right now. So, what does that actually mean for you? It means that when you see a massive move like this, your first question shouldn't be what's the fundamental story? Your first question should be who's getting forced out? Because here's the thing most retail traders think markets move on news and fundamentals. And sure, those matter. But in the short term, especially during volatility spikes, markets move on mechanics. They move on who has to sell, not who wants to sell. There's a huge difference there. When someone wants to sell, they can wait for a better price. They can scale out, they can be strategic. But when someone has to sell, the market knows it. And the market doesn't care about your feelings or your thesis. It cares about your margin balance. Margin. Let me break that down even further. When you trade futures or options or any leveraged product, you're not putting up the full value of what you're controlling. You're putting up a fraction. That fraction is your margin. It's collateral. Now, when volatility is low and markets are calm, exchanges let you operate with relatively small margin requirements because the risk of big moves is low. But when volatility spikes, the exchange looks at the market and says, wait a second, this thing is moving 5, 10, 15% in a day. We need more cushion. We need more collateral from everyone holding positions. So they raise margin requirements. And that raise doesn't happen over weeks. It happens overnight. Literally, you go to bed with one set of rules, you wake up to another. Now, here's where it gets really interesting. If this is making sense so far, drop a comment below and let me know where you're watching from, because I want to know who's paying attention to this stuff. The education piece matters. When you understand the plumbing, you stop being surprised by these moves. You start expecting them. You start positioning around them instead of getting caught by them. So, what does that tell us about what we're seeing right now? It tells us that silver didn't drop 33% because the fundamental case for silver suddenly evaporated. It dropped because the mechanics of the market forced selling into a narrow window of time. And that's what I want to unpack next. Now, here's what's actually happening. Let me break down the sequence in plain language. Silver had a massive upside run over the last several weeks, pulling in leveraged traders chasing momentum. You know how it works. Price goes up, more people pile in. Price goes up more, even more people pile in. That's the feedback loop. And a lot of those traders, they're not buying physical silver bars and storing them in a vault. They're buying futures contracts with leverage. Maybe they're putting up 10 or 20% of the notional value and controlling the rest with borrowed money. That works great on the way up. But then volatility spiked. When volatility spikes, exchanges reassess risk. They have to. Their job is to make sure that if someone defaults on a position, there's enough collateral to cover it. So the CME looks at silver moving 10, 15, 20% in a session, and they say, okay, we need more margin. So they announce a roughly 36% margin increase effective tonight. That means anyone holding leveraged silver positions suddenly needs to post a lot more cash before the close, or they have to sell. And here's what's wild about that timing. It forces selling into thin liquidity. Late in the day, when bids are already nervous, the market knows what's coming. Big players know margin hikes are hitting. So they step back, they widen their spreads, they wait to see where the forced selling lands before they step in. So when that trigger hits, here's the cascade. Forced liquidation pushes price lower. Lower price triggers more margin calls on other traders who were barely meeting their requirements. Those margin calls force more selling. More selling pushes price even lower. And suddenly it looks like demand vanished, even though it didn't. Demand is still there, but it's paralyzed, it's waiting. Because why would you step in and catch a falling knife when you know there are thousands of leveraged positions that have to be closed before the bell? You wouldn't. You'd wait. And that's exactly what creates these violent, fast drops that feel like panic but are actually just math. Now, let me show you what most people are missing. And this is the part that should make you nervous. This wasn't just a margin hike in a vacuum. There were reports of heavy positioning by major banks. There were temporary disruptions at the London Metal Exchange. There were even systems issues at HSBC floating around at the same time. Now, do exchanges and banks deny coordination? Yes, they do. Could some of this be coincidence? Possibly. Markets are complex systems. Things break. Timing overlaps. I get it. But here's the part that should make you pay attention. When multiple stress points hit at once, leveraged retail traders don't get the benefit of the doubt. They get liquidated, mechanically, automatically. No conspiracy required, just math. And let's talk about that for a second, because this is where people get emotional. When you see your position get stopped out at the worst possible price, when you watch the market drop 30% in a week and you're sitting there thinking, this has to be manipulation. I understand that reaction. I really do. But whether it's manipulation or not, the mechanics are the same. The margin call doesn't care about your theory. The exchange doesn't care about fairness in that moment. They care about risk management. And if you're over leveraged, you're the risk they're managing. That's the cold reality of trading with borrowed money. Here's what really validates this thesis: the timing. The margin hike was announced days ago, but it goes into effect tonight. That means every trader holding silver futures knew this was coming. They had time to prepare. They could have raised cash. They could have reduced size. They could have hedged, but a lot of them didn't. They held on, hoping price would bounce before the deadline. And when it didn't, they had no choice: sell or post more collateral. And for a lot of traders, posting more collateral isn't an option. They're already fully deployed. They're already maxed out, so they sell. And that selling creates the waterfall we just saw. But there's another layer here that most people aren't talking about: the convergence of liquidity and positioning. Silver's a relatively small market compared to something like crude oil or the S&P. That means it doesn't take as much capital to move it. And when you've got a bunch of leveraged longs all hitting the exit at the same time, there's not enough natural buying to absorb it. The market makers step back. The algorithms widen out. And you get these air pockets where price just falls through levels that should have held. That's not a conspiracy. That's what happens when forced selling meets thin liquidity. It's why volatility in silver can be so extreme compared to other markets. The float is smaller, the leverage is higher, and when things unwind, they unwind fast. This is the exact same playbook we've seen before. Go back to 2011, when silver was surging toward $50 an ounce and everyone was calling it the trade of the decade. What happened? The CME raised margin requirements 5 times in 8 days, 5 times. And each time they raised them, silver dropped. Hard. You had violent down days, emotional closes, stops getting run left and right. And then, after the selling exhausted itself, weeks of chaotic aftershocks before any real base formed. The rally was over, not because the fundamentals changed overnight, but because the leverage got pulled out of the market. And without that leverage, there weren't enough buyers to sustain the move. Or look at March 2020. Different assets, same mechanism. When COVID hit and markets went into free fall, margin calls forced selling across the board. Even in assets people wanted to own. Gold dropped. Treasuries dropped. Things that were supposed to be safe havens got sold because traders needed to raise cash to meet margin calls in their equity positions. That's the interconnectedness of modern markets. A forced seller doesn't get to pick and choose. They sell what they can where they can to meet the call. And that creates dislocations that look insane in the moment but make perfect sense when you understand the mechanics. Zoom out and you see the pattern. When leverage builds and margins rise quickly, price overshoots on the downside. Not because fundamentals collapse, but because positioning does. The larger story is that forced selling always looks like panic until it exhausts itself. And once it exhausts itself, once the sellers who had to sell are done selling, that's when you start to see real price discovery again. That's when the buyers who were waiting on the sidelines step back in. That's when you get the bounce. But until that forced selling is done, trying to catch the bottom is just guessing. Now, before we go further, I want to be really clear about something. I'm not sitting here telling you this is definitely the bottom. I'm not telling you to buy right now. What I'm telling you is how to read what's happening so you can make your own informed decision. Because that's what this channel is about. It's not about me giving you buy and sell signals. It's about teaching you to see the market the way someone with 20 years of experience sees it, so you can develop your own edge. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this move mean something more bearish? Sure. Could it signal that the rally went too far, too fast, and that the fundamental case for silver was overstretched? Absolutely. Maybe industrial demand isn't as strong as people thought. Maybe supply is coming back online faster than expected. Maybe the macro environment is shifting in ways that don't favor precious metals. Those are all legitimate possibilities. And here's the thing about manipulation claims: they're emotionally satisfying, but they're rarely actionable. You can't trade accusations. You can trade structure. Whether JP Morgan was positioned one way or another, whether there was coordination between exchanges and clearing members, whether this was a deliberate takedown or just an unfortunate confluence of events, it doesn't actually change what you do today. It doesn't change your risk management. It doesn't change the levels you're watching. Focus on what you can control: price, levels, volatility, liquidity. That's where real edge lives, not in theories about who's pulling the strings behind the curtain. I'm not saying those theories are wrong. I'm saying they're not useful for making decisions in real time. And let's be honest, even if this was a coordinated effort to shake out retail traders, so what? That's the game. The game is played by people with more capital, more information, and more sophisticated tools than you have. That's always been true. It'll always be true. Your job isn't to complain about the game. Your job is to understand it well enough not to get run over by it. And that means recognizing when you're on the wrong side of a forced liquidation event and having the discipline to step aside until it's over. There are probably three types of people watching this right now. First, you might be holding silver and feeling absolutely punched in the gut. You bought into the rally, you believed in the story. Maybe you even added to your position on the way up. And now you're sitting on a massive loss, wondering if you should cut it or hold through. If that's you, I get it. I've been there. The key question isn't, was I wrong? The key question is, am I over leveraged? If you're forced to act by margin rules, the market is making decisions for you, and that's the worst position to be in. If you have the liquidity to hold through this and you still believe in the fundamental case, then maybe you hold. But if you're getting margin calls, if you're losing sleep, if this position is bigger than you can afford to lose, then the right move is probably to cut size and live to trade another day. There's no shame in that. The market doesn't care about your pride. Second, you might be flat and furious, watching from the sidelines, thinking this whole thing is rigged. You saw the rally coming. You watched it unfold, but you didn't pull the trigger. And now you're watching it crash and you're thinking, see, I knew it was manipulated. I knew they'd never let it run. If that's you, your edge is patience. Forced selling creates information. It tells you where the weak hands were. It tells you where the leverage was concentrated. Let it finish talking. Let the margin hikes take effect tonight. Let the sellers who have to sell finish selling. And then, once the dust settles, reassess. Maybe there's an opportunity on the other side of this, maybe there's not. But don't let anger cloud your judgment. The market doesn't owe you anything. Third, you might be actively trading this volatility. You're in and out. You're scalping the swings. You're trying to catch pieces of these moves. For you, discipline is everything. Size smaller than you think you should? Respect levels. Don't confuse noise with signal. And for all of you, the universal rule is this: when rules change overnight, price discovery gets messy before it gets honest. That's just how it works. The transition period between old margin requirements and new ones is always chaotic. Always. Because you've got some people scrambling to meet the new requirements, some people front running the forced selling, and some people waiting for the whole thing to blow over. That creates chop. That creates fake outs. That creates pain. So here's what I want you to answer in the comments. Which of those three camps are you in? Are you holding and hurting? Are you flat and watching? Or are you trading this actively? I'm genuinely curious because understanding where you are mentally is just as important as understanding where the market is technically. So here's where I stand. I'm not panicking and I'm not blindly buying either. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether $80 to $82 holds into the close tonight after the margin hike actually hits. If that level holds and we don't see a flush below 80, that would tell me the forced selling might be close to done. It would tell me that whoever had to get out is out, and that would set up a potential base for a bounce. Second, I'm watching the $70 to $75 zone as a potential final washout if selling accelerates. If we break 80 and there's real conviction on the downside, that 70 to 75 area is the next place I'd expect buyers to show up. It's a psychological level. It's roughly a 40% retracement from the highs, and it lines up with some prior resistance that could now act as support. Third, I'm monitoring volatility itself. If volatility contracts after margins take effect, if we stop seeing these 10 and 15% daily swings, that's usually your clue that forced liquidation is burning out. When volatility settles, it means the sellers who had to sell are done, and the market can start trading on fundamentals again instead of mechanics. Based on my analysis, this move was mechanical, not emotional. It was structural, not random. The fundamental picture for silver, whether you're bullish or bearish, didn't change in a week. The supply and demand dynamics are still what they were. The industrial use case is still there, the monetary case is still there. What changed was the positioning. What changed was the leverage, and when leverage unwinds, price moves fast in the opposite direction. But that doesn't mean the underlying story is broken, it just means the froth got blown off. Now, does that mean we rally back to 120 right away? No, probably not. These kinds of forced liquidations tend to leave scars. They shake confidence. They make people gun shy. But if history rhymes, and if silver can find support in the low 80s or even the mid 70s, the move that follows could be significant. Because all that forced selling creates opportunity for those who have the patience and the capital to step in when others are running for the exits. I'm not a financial advisor. This is not financial advice. Do your own research. Seriously, don't take my word for anything. Go verify the margin hike yourself. Go look at the historical precedents I mentioned. Go study how forced liquidations work in leveraged markets. That's how you build conviction. That's how you develop edge, not by listening to me or anyone else tell you what to do, but by putting in the work to understand why markets move the way they move. If you made it this far, you're part of a rare group. Most people don't have the attention span or the discipline to sit through a deep dive like this. They want the quick take. They want the hot tip. But that mentality doesn't build wealth. It builds losses. The fact that you're still here, that you're willing to learn the mechanics, that you're thinking critically about what's happening instead of just reacting, that mentality will serve you well. Not just in this trade, but in every trade that follows. If this breakdown helped you see the market differently, do me a favor. Share this video with someone who needs to hear it. Someone who's holding silver and panicking. Someone who's trying to make sense of this chaos. And if you're not already subscribed, hit that button, because this is what we do here. We don't chase hype. We don't sell you dreams. We teach you to read the market so you can make your own calls. That's the edge that lasts. Stay sharp out there. Think critically, verify what you hear, and make your own decisions. I'll see you in the next one.